just do a quick review. So S&P 500, 1.66% up over the past 1 week. QQQ, 2.7% up. And then I just share a couple of headlines that I was looking at yesterday, which I think quite interesting. I think this one was a few days ago. The job report was out. US economy added 263,000 jobs. I think it slowed down compared to 2021, but the number of jobs added is still higher than the pre-pandemic average. That's why I think the takeaway from this is that the economy is still hot, and those who lost their job are still able to find their job quickly. So we are not in recession yet, at least if we just look at the job report. And then this is the unemployment rate. You can see that the unemployment rate shot up during the COVID, and after that it's still went down to about less than 4%. So if they continue to do this monetary tightening, I think we should expect the unemployment rate to come out. But as of now, it's still at 3.7% now. So the economy is still hot. And hence, if we just look at this report, the monetary tightening will still be ongoing for some time now. The pivot is not going to be that soon. And then the other report that I saw, which is quite interesting, is this one coming from Wall Street Journal. They detail about like Apple plan to move their production out of China. All this is because of the COVID lockdown situation in Zhengzhou in China, right? So the situation is really, really hard. I think that there's news that say it affects the production of iPhones. I don't think this is like a short-term thing. It's going to be, it will take some time for them to increase the production capacity outside of China. I think one place that they're looking at is India. But then India and Vietnam and all these other places in terms of capacity is definitely way below China. But hopefully all this will push into the direction to diversify the productions. If not, Apple is always, like closely tied with China. If anything's wrong with China or relationship turn bad, right? I think it will be quite problematic for Apple to navigate. So I think this one is good in terms of diversifications for Apple, but bad in terms of whenever they try to do all these things, they move out from China. Basically, they are not utilizing the skill that they have in China, which means I think the cost of production will be a lot higher. And this one is also related, right? This one is talking about TSMC plan to build more chip manufacturing in US. And also Apple is the one that pushed them from behind. So say they have to do all this a lot more. Hopefully this is good from diversification perspective. Okay, I'll start from the first questions. Open to all. When you are enjoying very large gains, more than 80 to 100%, how did you decide to sell that positions? And these questions come from Boon Song. Boon Song, you go first. You are the one who asked, so you share first.
I mainly because I only have one experience with this kind of good fortune, and that one was mainly due to market speculation. The stock went up like 300% in just a space of months. So it was like going week after week, it's going up and up. So I think it is very clear that the price has really went far beyond the value. To me, I was lucky to sell it at its high. So what made me decide to sell the position is I was waiting for the earnings release, because in the run up on the price, the management was continuously putting out good news saying that, record sales, and the main shareholder was constantly buying shares, even though he have a huge amount of share options which he could easily convert. They are already in the money. To me, I see a lot of this as cheerleading activity or behavior by the management, and I always believe that management should have this responsibility to keep the price reasonable, not to cheer the price up, and also not somewhat to ensure that the price does not go down too much due to their malpractices. So when the earnings result was out, I could see that the fundamentals was far below the value. In that the earnings growth was actually not there. Business was actually just a beauty business, and they are moving on to men's health. The men's health part, they were just at the initial stages, so it's not reasonable to expect huge growth. But when it comes to their main bread and butter business, which is beauty business, there wasn't much of a proof in the numbers to suggest that they are worth that much amount. So I sold off. To give you an idea how market functions, you will always expect that the market will sometimes be unreasonably optimistic. And when Graham said in his book, The Intelligent Investor, the market is there to not to guide you. That's what I mean. If you really believe in what the market was telling you that time, it went from $3, $2 to as high as $10. And if you have no sense of valuation, you'll be thinking that the market is right, it's worth $10. And perhaps you would even be tempted to buy more at that time. So I sold when I know that the numbers was not suggesting something that the stock price is worth that much. So I start to liquidate a bit. So yeah.
So
eventually,
after you sold, what happened to the price? Like you how many tranches you sold that position?
What happened was at $3, $4. I already stopped buying when it was at $3. I thought it was reasonable priced at $3. Then it went up to $10, $9, $10. So at I think earnings days -1, right? It was already 9 plus. And then right before earnings, it went to $10. And then after I sold, I actually sold it pretty quickly. I was selling it on the way up, but when I got the earnings report, I sold it immediately. Sold everything that I had.
But
yeah,
did it went up after you sold?
It went down. It went down from $9 plus to $3 plus or $4. Yeah.
So you literally sold at the peak, or close to the peak.
Yeah. I was very lucky. It's like most of the time, right? If somebody tells you that, hey, I'm very skilled, I managed to sell right at the top, I don't believe that bullshit, seriously. Nobody know how high the stock price can go. So it was just mere luck. You know, it's like you if you go to the street, right, and see two fat guys, you never know, you know they are fat, but you don't know which one is more overweight than the other. You go what I mean? It's just, you know that a stock is overpriced, but you don't know how badly overpriced it is. But if you are a fundamentals guy, and I think that's one of the advantage of being a fundamentals guy, your head will be pretty level. You don't go crazy when the stock price goes up. You know when to sell. And if the price goes further up, like maybe you sell at this price and maybe 2 months down the road, it went up 20% again. You don't feel so you don't feel so sad because you know that the fat is getting fatter.
But then usually it's like this, right? You buy into one position, you look at it from the FA perspective, you bought already. Let's say it's at $3. You think it might worth $5 or even $7, right? You buy first. And then when it shoot up to $10, and then you think that, oh, now maybe it's on the expensive side already. You plan to sell already. Suddenly you just get up another to $12, $15. And then that time is time you suddenly shift, you mess up with your time, your mind, right? Because you might think that, okay, maybe there's something behind it. Maybe there's something justify the high price. So you started to like forget about all the fundamentals already, because you have a rational mind when it was trading at the range that you think is reasonable, maybe between 3 to 7. Once it go to 15, 20, like that kind of like irrational prices, right? So it become like the trading already, at least from the emotional point of view. Don't you think so? Did you experience that?
Yeah, not much. Because most of the stock I bought are very boring, unsexy stocks. So they were never blown up to sky high valuations that are out of proportion. So I don't have that kind of experience, but I also I got emotional control. I don't join in after I sold. Because I always believe that the higher the price, the more risky it is. Let me put it this way. When that 300% stock went up to even 100% at $6, $5, I didn't buy anything. In fact, I told all my close friends not to buy and deal a lot of abuse, because when you have friends that you talk to every day and the stock price went from $5, $6, and then you tell them I didn't buy anything, I'll suggest that you don't buy. And then just 2 weeks later, it went up to $7, $8, and then you had to endure why you tell me don't buy, that kind of questions, But I never to feel that. I mean, when it comes to selling, you have to be reasonable. To understand that there will always be times where the stock price go up so far. It's not something that you can expect. You don't have to kick yourself over it, because it's not something that you can intellectually account for. I can understand that feeling, but I don't fall victim to this kind of behavior.
Yeah, always cool-headed. What about Kyith? You have any stories to share this kind of situation? I think you are in the market way longer, right? You should have this kind of experience.
Regarding what's the question? I didn't get the question. Can you hear me?
Okay. The question is, have you have experience owning a positions that went up by 200, 300%, and then how do you did you sold, or did you, how do you manage?
Don't have lah, so I don't have this problem.
Is this because your investment, most of them are in the funds, so they are diversified, so you don't have this type of
No, I mean, last time I used to invest in individual securities, but maybe it's because of the nature, they are dividend stocks, right? You don't have that issue. Probably there's only one stock that I have that held the longest was, I think it went up maybe I think got 300%. I can't remember clearly right now. I think it was Straco. I think I bought it at 17 cents. Then I think for a long while it stayed at $1, is it? Most of the time it's fundamentals driven. If you can understand the fundamentals, the reasons why you sell it, the way that I look at it is the fundamental momentum is not there anymore. Like you've seen some like realistic headwinds along the way that maybe it's better to move to the sides or something, or that usually, because usually we operate in all these like smaller micro caps in Singapore, right? Most of the time, the fundamentals, the quality of it is quite cui one. So that means that like you have to give more benefit of the doubt that actually they are not as strong as you perceive. So when the earnings are starting, when you see the business is facing some headwinds and all, maybe it makes sense to actually like reduce the position. Because in the case of even Straco, right, I think we give enough benefit of the doubt. You understand the landscape that is operating. And I saw it, I think, even earlier than all these COVID kind of situations. So you can't say that some of these things are very glaring or something. But it's when you look at like what Boon Song said, you look at all the earnings report and all, right? You give them 1 quarter, then you give them 2 quarter, because things usually don't change so fast. But you see something that fundamentally you think, hey, this is not very comfortable, then I think it's right time to actually sell off already.
Yeah, but for these positions, right, you mentioned 300%. Does it happen in holding it for a couple of years and then it increase by 300%? Or is it like really short period of time that you can feel the excitement within weeks, then suddenly just shoot up by 50%? This kind of situations?
No, not those. Not those. The probable ones that maybe is something like that is AEM holdings. That one is like really very fast, share of the 100%. Then I just sold it. I sold it with my friend. You have to understand like why I sell it. I think in another time frame or in another degree of sophistication, right, I might not have sold it because like we have enough skepticism like hey, okay, for some background, because AEM is like some people might not familiar with. They were those kind of small scale manufacturers, contractors for a long time. Then suddenly there is news that they are doing this for Intel. Then of course the skeptical brain will be thinking like, why all of a sudden like such a big company would actually partner up with these small companies like that. So most likely then you see a lot of the news that is coming out. Wow, it seems that they are really pushing the story along. I think like Boon Song, like that, we have enough skepticism. Like this kind of thing is not something that we are comfortable with. This kind of skepticism saved us a lot in the past and all. So you look at this one, it's like, okay, I think this is being pumped up. So you just sell. Hindsight, I think I miss out on maybe 200K or something. So
you mean if you sell at the peak, you miss out that 200K. But
even if I don't sell at the peak, it will still be a good run, because I think if I remember, they split a few times. So just like I say, like if I don't have some of this skepticism, I a bit gong tao tao and all like in the past, right? Then I say, oh, this one I think the fundamentals have shifted already. And then I'll just hold on to it. Wow, like this is blue chip. Their customer is a blue chip business, just like UMS like that. Then it will turn out very well. So depends on some luck and some, but like knowing too much sometimes is also not really a good thing sometimes.
So this one, if you didn't pay attention, just hold on, because it is a value pick. I remember for quite some time, right? The valuation is reasonable. I think there's some growth, and then there's some catalyst also.
Yes, that's right.
I think when it comes to the stock market, right, you have to understand that the market price is always a multiple of its earning ability. It's not just how much it earns, it's also how much the market think it can earn in the future. This is what they call PE expansion, right? So sometimes it's very, very difficult to say that, oh, this price is is a bit overblown, because some years later, maybe the company might prove you wrong, you see. Yeah. I don't know whether AEM, did they prove you wrong in the future? I mean, after you sold, did they really deserve that kind of valuation?
I think valuation wise, I can't comment because I didn't follow it so much nowadays, but it's still operating. So it proved me wrong. Lor. So they still have their business, and then it's still like sometimes they do come out with positive profit revision. They're still doing those kind of things. So yeah, lor, you look at things in a spectrum like some of these things. We focus on some of these risk management thing because there is enough instances that tells us like usually they don't end up very well. But there are some that is like really like CEO is like that one. No? Some of the management is like that. Lor. They just like to do all this marketing stuff. Yeah.
I still remember maybe a handful of years ago there was this company called MM2 Asia. Yeah, it's also one of the darlings. MM2 Asia was the darling. Best World also a darling. So all these stocks were going up 200-300% in very quick order, you see. And I wouldn't say that the management was cheerleading, but its shareholders were in the internet forums, the shareholders were very, very optimistic about the company. So when it comes to MM2, right, you just look at they were very motivated by the income statement. But when you look at the cash flow statement, you could tell that it's actually a very cash-draining operation. So bad things can happen, and bad things did happen. Was it because the business was no good? I'm not too sure, but the pandemic did them no favors. So as you know, what happened was they took up huge leverage to buy over Cathay, and they sold it, to save themselves. The share price didn't go very well. Yeah. But as for Best World, I wouldn't know whether I don't think the story has ended for Best World. And I'm not saying that it's a good story. I'm saying that maybe bad things can happen in the future. But right now, there's still a lot of talk that the stock is cheap. The management will do well in China. That remains to be seen. There's a lot of stock like this. I mean, you possibly can have huge gains with all these story stocks. But you know that, let me put it this way. There are a lot of stocks that can give you 200-300%. But if you look at a stock that goes up 1,000, 2,000%, like a McDonald's and all that, you could understand that there's actually a business that is scalable. There's actually numbers there to prove that they deserve such kind of valuation. And over a time frame of decades, right, it's usually not luck.
Yeah, that's why I say it's very different if you look at those like went up a lot within short period of time versus those that take 3 years, 5 years to compound. Definitely different situations. Those that take years to compound, you don't feel the excitement at all. You just see that year over year, the earning increase, the revenue increase, hence the valuation increase. It doesn't feel like excitement, right? But it compounds.
Yeah, even for these stocks, right, that you cannot deny that there are times where the stock price go down a lot, you see. So it's very difficult to hold on to a stock. Even though maybe 20 years later down the road, you say, hey, wow, this stock went up so much. Why didn't you hold it back then? But we don't know how it feels like for a stock to go down 50%. I mean, within our very little circle, we all know how it feels like now because 2022 was such a bad year. But even for these stocks that went up so much, 2,000, 3,000%, there are years where you get half. And maybe it's not just 1 year, but many years. So holding on to them takes effort. You have to give people who had this kind of gains, right? You have to give them credit for holding on for so long. And it's not easy.
Yeah, I just share the screen again for those who joined a bit late. So we are still at the first questions asking, when you are enjoying a very large gain, how did you decide to sell that positions? So I saw there's a list of participants here. Anyone want to share your story? Like, do you have this kind of story that you are still holding on, or you sold already, you want to share? If no, then we move on. How you define Fed pivot? Is it just one reduction from 0.75% to 0.5% is considered pivot? I think this is a quick one. I just quickly answer that. So I think the pivot, right, will pivot means that they change, and the change means they change from tightening policy to a loosening policy, or the other way around. So if we are looking at 75 drop to 50 basis points, but they are still increasing the short rate, right? It's still considered tightening the monetary policy. So this is not considered pivot. They need a cut to consider as pivot now. So even if they've just pause it, like not change, like keep the Fed fund rate constant, right? That one is still not a pivot until they suddenly say, okay, we announced a 25 basis cut, and that one is considered pivot. So I think this one, quick one, just go through it. In the past, any reason why the crash always happened after the pivot? This one I am interested to hear from Boon Song and Kyith.
I never bother about what the Fed says. Never.
So no comment. What about Kyith? I'm sure Kyith has look at all these past data to show like, oh, this period that they do a cut and then we have further crash, right?
I think this one is more like, maybe they're referring to that. Usually, if you look at the data, right, whenever there is those kind of like drawdowns with recessions, right, usually the deepest part about the drawdown, right, happens after the recession. It's not before the recession. So basically, in general, if you have a drawdown means that from the peak it falls down lah. If it's a drawdown, it can occur with or without recession. Usually, without recession, it tends to be more shallow and the recovery should be faster lah. But if it comes with a recession, right, then usually it's more challenging to deal with lah, which means that it's longer and deeper. So that's why you see a lot of people looking at the data and then seeing whether are we going to expect a recession coming or not, and that will give you a certain idea like how deep things are, how you're going to allocate your capital, all those sort of stuff. Now, what's the reason? And also the data shows that usually, if let's say we look at the 50% market falls, right, usually the deeper part is usually after the when the recession comes. So why that is the case, I'm not sure. I feel that it's a lot deal with animal instinct. You get when the business cycle gets in a recession, you see more challenging companies, and then you see more news like Lehman Brothers and all those sort of stuff. Then of course, the market tends to panic and they tend to sell down even more. And I think nowadays the market is such that with all these, last time the market wasn't so dominated by options, people playing with options, institutional playing with options. So some of these flows, they definitely enhances these kind of like upward and downward moves. So you should see more like pronounced. Like if you look at whatever happened in COVID, right, it was like quite scary lah in terms of the shooting up and the shooting down.
Yeah. Just now you said the largest drawdown happened after the recession. You mean after the recession started and after it's confirmed it started? But by recession, sometimes it could be 12 months, 18 months, but it will be like after the recession started, but within that recession period, right?
Yeah. I'm not sure whether I can bring up some of these data or not. Probably if I give me some time, give me like later. Usually recessions, the market recovers before the recession ends. Okay, usually it's like that. Yeah. Recession can be fast or slow. So that's why it's kind of difficult. It's like if you wait until the recession officially ends, right, then you invest, right, that's usually you're not gonna catch at the lowest point.
Yeah, because the market always anticipates, right? They saw that the signs of ending of recession, it already went up. But before that, I also wanted to ask you one more question. Do you think that this recession will come? This one, many people talk about this. Like I get mixed like survey, like mixed result. I would say most people, let's say 70-80%, whoever who have a view, right? They will say there will be a recession 2023. Only small percentage of people think that we are going to skip the recession or have a very shallow recession. What about you?
I don't know that. I usually leave this kind of thinking to my investment team back in office. But even then, for them, right, we don't anticipate things like that. It's like most of the time, I think what we're dealing with is explaining like play by play, how is it currently, and whether it's an official recession or not, right? Like it's not very useful for us. So, but we tend to need to know this so that we can explain to clients lah. So long and short is that I don't know lah. But my gut feel is if every of us is expecting it, right, then how deep can it get? It's like now people are really cutting the labor or doing all this kind of thing in preparation for something, all the slowdown already. But caveat, like I'm really not good at this. So this is just a really gut feel.
Yeah, got it. Thanks. Okay, I will share my view on this, like why after the Fed pivots, then the market continue to crash. I think this one is really depends on what's happening during each of all this big drawdown in the past. So in the past, right, usually the sequence is like this. The market is very hot, and then Fed start to tighten the monetary policy, and then the short rate will increase. And when the short rate increase, it makes those whoever borrowing money will become more and more painful because you need to serve more, like higher interest costs. And then you will see that during this kind of period, there will be players that is those, especially those who are over leveraged, and they will have problem. For example, like you just overextended yourself, bought too many condos, and then now suddenly interest rate increase is very painful for you, right? So there will be players who will like break during this period. So basically, some big institution will face some difficulty, and all this will become more and more obvious to one point. Then Fed will be aware that, okay, this one, if we just continue to do the hiking, right, then the problem will be much bigger. So when they see the weakness in the economy and so on, like there's maybe some big institution facing liquidity problem, they will start to like pivot because they know that they continue to do this, it will be a larger problem later that they have to face, which is a recession or some big banks collapse and so on. So the moment they do the pivot, right, this is when the economy or all this financial system at the weakest point. So they will do the cut in order to save the market. But usually that point is not so much like everything turned out like happen instantaneously. So once they do the cut, right, all these problems will still continue to face on because whatever policy that the Fed put on, right, for example, like all this monetary tightening, right, it won't be felt immediately. It will take some time to play out. So whenever they do the cut and then you just see whatever that's playing out in the next 3 to 6 months, you see more problem popping up, and some of this problem is big enough to cause panic. That's why like if you just think back during, let's say, 2007 and 2008, you can see that actually when the Fed cut the interest rate, that's already a period that people already over leveraged, and all these companies or people, they already face some problem there. So the problem is not the Fed cut. The problem is just that all this happened, the sequence of it now. But again, all these things, right, you need to be mindful that we only have, say, like, let's say over the past 20 years, we don't have like 200 data points to study all these things. We are talking about few data points. So people are taking all these like 3, 4, 5 data points and try to make story out of it. So everything that anyone just say about all this recession, about the big drawdown, right, you have to be mindful that we're talking about small data points. So because the data points is only like 2 or 3, so you can make any story to fit, right? You only need to fit 2, 3 data points. It's a lot easy compared to like you really have extensive data that anyone can point to you that, hey, actually you see this, you are right on 80%. There's another 20% data point that you are wrong, that you didn't describe it correctly. So I think we just need to be mindful on that. Where to find Baba buyback announcement not reported on SEC and HKEXNews, also not reported on Baba website. 700 got report since like 9988, very fishy. Okay, they didn't report it on a daily basis. You look at their website, okay, it's shown here. This is the investor relation website. So every quarter when they announce the result, you just click on the result, and then there's a PDF file that you can look at. Every quarter they actually detail it in that PDF document. So say for example, this is the latest one. They will say how much they bought, and then at average of what price and so on. So if there's any change of like their buyback mandate, right? So they also detail here. Say, for example, this round, they say they are going to increase another 15 billion the share repurchase program through end of March 2025. They also detail here. So all these informations about the share buyback, right, at least for Alibaba, you can find it from that documents. All come back to this place here, the quarterly results. I think this one, I also don't know like what are the rules for all these companies. But I think for Tencent, I think they really like update the share buyback quite frequently. But I don't know like what are the rules, right? So I believe you just need to be mindful of like which company that we're talking about. Some they put it in the financial quarterly result. Some they have more active disclosures. So it really, as long as they satisfy the regulatory requirement, I think that's fine. I don't think they are required to update this on a daily basis whenever they buy back their shares. Okay, so that's and thanks to Hayden for confirming this, because I also don't know. I thought that there might be somewhere that they announce it on like a frequent basis, but Hayden mentioned to me that there's none. You just have to look at these quarterly results. Wow, Bitcoin questions. Will Bitcoin die if mining became unprofitable? I think the answer to this, I don't know, let me do a quick one. I think we won't go too deep into this. I think the answer is no. Because there will always an equilibrium between how much, how many Bitcoins is mined times the price versus the cost to do the mining. So say, for example, when Bitcoin mining become unprofitable, so there will be miners that will just stop their mining machines because it doesn't make sense, right? Say, for example, you go and spend $1,000 on the electricity to mine Bitcoin worth $500, right? You won't do that, right? Why not just stop the machines and take the $500 to buy the Bitcoin on the exchange, right? So this one itself, it will have equilibrium. So you don't have to worry about this. So and Bitcoin will not die because of this. Because what Bitcoins do is just a ledger. So and the transaction can still happen even with a handful of miners. But you can say that, let's say if all these Bitcoin mining like majority of them shut down, and then it will be easier to attack to get the 51%. I think that one you can still argue, but it's still very hard to get a 51% mining capacity. So I think that one still can say, okay, it's less robust as compared to when Bitcoin price is high and there's many miners. So I think based on my limited knowledge on this, I don't think Bitcoin can die so easily. So to answer these questions, the profitable, unprofitable, I think it will work out on itself just because of all the supply demand of mining capacity. It's just based on rational response on the prices now. Okay, this one I think interesting. Can go around and see what are the responses from the rest. Is the recent rally even sustainable? Looks too good to be true. I'll just stop the sharing here and then see. Busong, you want to contribute on this?
Didn't feel like a rally to me. I still enjoying losses. Yeah, I know that there are a lot of stocks that have recovered tremendously, but my one is not one of them, so I don't know what to feel. But I think for the handful that went up, they are in my mind space. I do think that they deserve to have a higher price than they had to suffer in recent weeks. So it's not something that's a result of speculation. It went down too fast. So it's reasonable to believe that it can go up fast as well. Just don't be too optimistic. Yeah. Let's say if you look at maybe I just saying maybe you feel that maybe Tencent is worth a lot more, right? And then it went down to about 220 to 230 Hong Kong dollars in just maybe a few months ago. And now today is very close to 300. So you'll be thinking in your mind, oh dear, I missed out on all that gains. So maybe I should go in right now and buy. But the only question you need to ask yourself is $300 cheap? And would you buy more when it goes back down to 220? So if both answers are yes, the way I deploy capital is if I believe that it's worth maybe $500, $300 is so cheap compared to 500. But if I think that it's worth maybe $400 and today's Tencent is worth 300, that means that my upside is only 25%. So your risk, right, is your downside. So do you need to put in so much money just because you have to be honest with yourself? You put in that much money because you sense the momentum and you want to be part of that momentum. In street speak, it's called FOMO lah. But if that is the case, then why not? You have to be very honest with yourself. How much is Tencent worth to you? Because when it goes down to $220, right, you'll be alone in your room thinking about whether you make the stupidest decision in your life. Or will it be just a reflex to buy more? And that's the difference between money being made and money being lost.
I think this year has been quite bearish for a while already. So it's due for a bounce and all, but it's explained. There's reasons to explain it because everyone is, I think, watching whether when the Fed is gonna do some pausing or some tilting, and if there is like bad news, if let's say there's bad news in the economy, that means that they're not gonna hike so fast, or if inflation numbers is better. So what we're seeing is a reflection of that, and so there is rally lah, and there is no external bad news, and like I say frequently, like a lot of these things is actually like amplified by the trading that is more prevalent recently. So you can look at the recent rally in two ways lah. Okay, actually it's in one way lah. Depending on what was said a few days ago, right? The market could instead of rally, right, it could just turn down. It could just amplify down. That's how the market is right now. So in a certain way, why it ended up this way was because most of what he said was quite favorable lah. But you can think of it in the other side. If he decided to be more hawkish, right, then we just turn down, or then we won't have this discussion and anymore. So it's a little bit like going forward. Are they going to be more? The market is going to be more receptive to more good news or bad news, because at a certain point, some of these things would turn. Like when instead of now everyone is happy that there's more signs of recession because most likely they're gonna pause soon. Then at a certain point, all these bad news, right, will really be bad news, and then and that will actually cause the market, instead of market to go up, it will cause the market to go down. So, and the market reacts to a lot of these. Like you can look at it as a spectrum of probability, right? The participants, right, they have an idea like what is the spectrum of possibilities that are out there. Like there is this probability that is positive, there is this probability that is negative. Then suddenly you have things like let's say China starts attacking Taiwan. No one expected this. Everyone thought about this. No one expected it to be so fast. Market's going to react. Yeah. So that's how we look at it from the other kind of perspective lah. Yeah.
We have to be mindful on like what are the stuff that's already like people talk about it so many times, which is already expected, versus those that is truly unexpected. I think for now, all this inflation rate high, I think it become like already people know about it, like people pay attention to that, and then it's like getting boring of this already. Say for example, like the job growth numbers that looks good, right? Suppose I think when the job market looks good, there should be more tightening onwards, and stock price should drop a lot more. But indeed, if you look at the futures price, I think last Friday it dropped a lot, but it recovered after that. I think all this so-called the bad news like have not much effect because it's like already expected to a certain extent. But the stuff that is people haven't talked about, I think those are the things that will have much bigger impact to the market. I will just name a couple. Say for example, all this talking about like the BlackRock funds that they say they hot withdrawal, they don't people to allow because of the illiquidity problems. I think this is one. And then the other one is that actually as of now, still majority of the companies are I mean, if you look at the financial result, it still looks okay-ish. Some it's just like growth slowdown. It's like you compare year over year, it looks like flat, or let's say like single digit growth. We haven't experienced those like, okay, now instead of growth become negative. So if we saw that, I think as of now, I would still say most people haven't expect that to happen. In fact, there are quite a number of companies never experienced negative growth year over year, especially those higher growth ones. Once they suddenly show, oh, actually growth can stop, can become negative. I think that one is totally another things that will affect people's expectations on how to look at these stock markets. So I think those are the one. Kyith, you want to show anything? Because I don't know, just now you found any data points that you want to show?
Oh, okay. Let me try.
Yeah.
Roughly dimensional, they look in depth into all the bear markets that deals with some recessions. So there's like about 17 or 18 of them in the past US history. So if you look at it, right, they are all pretty different. A lot of them, like some of them, they started, some of the drawdowns, right, they started before the recession. Some of them, they started at the recession. And then most of them, they recover before the recession. So usually a lot of them, there is some, like say for example, the World War II situation, right? I think the bear market is so shallow, right? And then the market just turned up. And you can imagine that it's during a time where you will naturally be a little bit skeptical about the markets. So, and because of that skepticism, you would think that there is something follow-up that happened, but there's no follow-up. The market just go up. So there's a lot of situation. What is interesting about, if let's say we're saying that this is something similar to the late 1960s and the 1970s, is that a lot of those, there is two bear markets during those situations. Like they started in 1969 to 1970. So that's like about 2 years. Then the other one is oil crisis that started in maybe 1973 to maybe 1976. That one is actually longer. So the interesting thing about both of them, right, is that the drawdown started like much, much earlier. Like in the 1969, 1970, that case, right? The drawdown was like, it started in even in 1968 till somewhere closer to 1970. So it's like they draw down 12 months already. Then the recession starts. Then some of the deeper drawdowns happen. So kind of like, if you look at the first part, it's kind of like our situation currently.
Yeah.
So that drawdown was like, let me see. The drawdown was 33.6%. Same kind of inflation climate and all that. But we have to keep in view that for our market, it went down 25% already. So it's not too far from this 33%. The other one, the oil crisis ones, right? It's something similar. It's only that the leading is maybe like about 6 to 8 months. And the drawdown was much shallower before the recession starts. And with the recession start, it actually took it down. The whole drawdown was like about 46%. So those are some of the periods that you could wonder that it's quite similar to the current situation. But there's a lot of those kind of situations where actually like recession drawdown is like 15% or 12% only. Then you start heading upwards already. So hard to say.
Exactly like what I mentioned. You only have what 2 or 3 data points. How to, like, if you have like 20 different episodes of high inflation causing recession, then at least we can study a lot more, right? But we're talking about like to the last one was what's in the 70s, right? Which is 50 years ago. That's why I think people also panic, because those who know how to manage this kind of situation never experienced this kind of episode. So also quite tough. Okay, thanks for the sharing. I think once you publish that, I think just now what you show you haven't published, right? Once you publish that, then we'll take a read on the articles. I saw there's quite a nice chart there. Can take a look.
I published already. I can share.
Oh, published already? Okay, nice. Can hear me, right? Okay, not on mute. Okay, I think this one will probably take some time to discuss also. How much blame should Finfluencer bear when the services or products they recommend go south? Okay, Finfluencer, who are Finfluencer here? I think Kyith is the one. You are the main one, right? You want to comment on this or not?
I think we discussed this before that, like personally inside our personal chat groups, and I think you can't run away from blame for this kind of things. But to me, like objectively speaking, you could say that these people are, myself included, not regulated, and you should be regulated more. But if we are regulated more, right, then would you actually believe more of what we say or not? Because of let's say we put all this that we're sponsored, we earn this, which we are putting. I guess the bigger part of the problem comes if, let's say, some of these strategies or some of these investments or things is actually like the quality of it is actually much lower than a lot of us anticipated. And this is whether the influencers, they do enough due diligence regarding this kind of thing or not. I feel that for most, if there are those that is like kind of like greedy one, they will just take anything. They will just put all the links below and then they say, it's okay, ma. It's like I just tell you the product, right? How this is how it works, right? You supposed to do your own due diligence. I put the links there. You click, I earn money. Okay. Then there are those that is like, but I think more of them is that more would have inside this field, they will do their own due diligence. Like whether they will see between the monetary rewards, but also that whether these products actually make sense or not. So, but doing due diligence, you can do all the due diligence you want now. And there is also a limit to something like that. Like if you ask me, I didn't share any FTX affiliate links, right? But if you ask me, I look at the whole situation, do I expect FTX to be like that? No. Okay? So very likely case in another possibility, if I have more time, right, you could see me write an article or saying how good to trade on FTX. And FTX is really a good platform to trade on, objectively speaking. So in that kind of situation, you can say that, hey, my due diligence is bad. But how different is this if you compare to saying like some of the things that I saw sort of tout in the past? Because I used to write a lot on Singapore small caps. Okay. And when we started off investing in Singapore small caps, right, we didn't know that the due diligence is such a large part of what you need to do. Because in this Asian or this emerging markets context, right, there is a lot of these kind of like things that screw up the minority shareholder. So imagine I write something until like this is like you have to buy this kind of thing, like something like a close one is what Boon Song say, best world lah. Like it skirts a very close line between like whether this one got a problem or not a problem. And then somehow or rather, it turns out that some of these stocks, right, it just blow up in our face. It's a matter of we try our best to do some due diligence. It didn't turn out to be very, very well. Then everyone gets hurt. So are we supposed to be part of the blame? Objectively, I already put a disclaimer already, ma. You shouldn't blame me, ma. But you ask me, should I take part of blame? Of course, lah. So what does all this actually mean? It means that, like, honestly, a real talk lah. I think part of it is that MAS should be more stern with us lah. Okay? But if they're more stern with us, right, I think it's going to make our jobs like damn difficult. That's like, I don't know. If there is so much, we've been in situations where some of the media agency that we deal with, right, they are more aware about all these compliance things. And then it just sucks to deal with them. It's so, you write until you don't know how many drafts you want to write just for one sponsored post. Then it's like after that you think, hey, is it worth it or not? So most likely, if let's say there's not good enough monetary rewards or something, right, people won't write about this kind of thing. So you will see these influencers go away. Then they have no monetary incentive to write. Then would you know some of the latest hacks that comes along, some of the latest pattern or not? Yeah, so it's not an easy situation to deal with. Yep.
I also think a bit that when a space is overly regulated, right, you kills the space, like you don't have that kind of breadth. I mean that number of participants talking about products, etc. But when it comes to capability, like how much blame the blogger, the influencer has to bear, I think they have to take some. As for how much, right, I broadly think of it in terms of two variables. What is their intent and what is their incentive? Like, for example, something not to do with investment. Let's say you are sick or one of your loved one is sick, and then one of your friends or associate tell you, hey, you should take this medication. It works wonders for me or my loved ones. And then you go and buy the medication and you feed it to yourself or your loved ones. And instead of getting better, they got worse. How culpable is that associate or friend of yours? What was his intent? Probably his intent is good, is to help you or your loved ones. But is there any incentives? I would say close to zero. I mean, the more maybe the more people buy that medication, he doesn't have anything to stand for, right? It doesn't have anything to gain monetary wise. So it brought me to many years back when I was still a very young person. There was this Slim 10 pills thing, So the whole gist of it is it has celebrity endorsement in the form of an actress. And funny enough, cruelly enough, the main reason why this case was so big is because another actress got ill, had to have a liver transplant. So the resulting effect is that what happened in the end? This company, the distributor, they were sued. So here comes the thing. The actress, right, who endorsed that pill, turns out to be the wife of a husband that was part of this the business, who runs this business. So how culpable are them? I think they are highly culpable because their intent could be good, but they are definitely incentivized to make sure that the sales are good. So let's put that context into our local influencer. If you will say that, oh, for every 1% that bought or subscribed to this service or product through me, I got more money, right? So as number of customers grow, the incentive, the amount of gains that I had increases as well. So that in its sense, right, would suggest that they should bear some kind of blame. But it's a difficult question to answer. How much, what kind of blame should they bear? But one thing is that I would think about is why, as we see are consumers of this information, what should we do? Firstly, we need to think about this intent and incentive thing. Okay, so we also need to think about how much conflict of interest does this person have. Let's say I say let's talk about this influencer called CZM and Kipo, right? Yeah, they suffer a calamity in that they invested so much in that service or product that they endorse. Do you think they should bear further criticism? I let your answer to that. And as consumers, we need to, going forward, we need to think about the service and product as well as the messenger. How much expertise does this messenger exhibit? Could it be just maybe a few days worth of work and they start saying that, oh, this is a good thing. You should have bought into it earlier, you know. Yeah. So, example, let's say if we know who's Warren Buffett, right? So how would it feel if one day you wake up, you turn on YouTube and you see Warren Buffett talking about TA, technical analysis? How much believability, how much seriousness will you entertain the message? Even though the messenger is a person who is highly regarded in the finance world. So we need to look at ourselves as consumer more. Yeah. So I know that there are a lot of people out there who is saying, oh, FTX this particular influencer should be we should be punished for what they said for about FTX, what they say about Hodernot. I would say, do you have anything to do with their incentive in the first place? Yeah. And how much, how should they be punished? If you have something or something clear, then that will bring some kind of, that will contribute positively to this discussion. But other than that, it's very difficult to move forward along this issue.
Yeah, speaking from influencer perspective, sometimes I also think that, for example, like they talk about certain products, and then let's say when times are well, right? Say for example 2021, they say, okay, you can use these, you can do some staking here and there, and then you earn like what 10%. When the times are good, right? People earn extra. Like instead of putting their monies in FD, they put their money into staking, and they get 10 or 15% out of it. And this one can last 6 months, 12 months, and they get good returns. But usually this kind of situation, nobody will say, actually, I give all the credit to the influencer who done the due diligence, and he really did a good job, and I profit a lot from this. I thank him. You don't hear this kind of statement. It's like, okay, if there's any good stuff, then I will just take as if this is like, okay, I risk my capital, so I get the returns. It's good for me. I shouldn't thank the influencers. This is all myself, right? I did my due diligence. Then come to 2022, then the whole thing collapsed, and then okay, this is someone else's fault. So there's this asymmetry between like, okay, if there's good stuff, it's all me. When things turn out bad, then I blame someone else. So do you think like it's like not fair for the influencers, right? Don't you think so?
They had incentives to act in that way. So you cannot say that they have zero blame. But the difficult question to answer is how much? How should they be punished? But I do think that it's like life. There's no complete white or black. It's always a very gray thing to most aspects. But I would say that they should bear a bit of blame. Not the most popular or good answer for most influencers to hear, but I think they should bear some kind of blame.
I think objectively speaking, right, like legally speaking, most of the terms and conditions for these influencers, right, they are more like introducers in our financial planning world. Introducers means like actually like you forward these people to those financial professionals, right? And then but in a certain sense, you can only say so much. You can't go out of this certain box and all. And if all of them they abide to that, right, then objectively speaking, like it's up to you to decide whether you eventually invest or not. So in terms of, I think most of these regulations, right, like whether it's, we went through this in the past, like I got hurled into, not say hurled into, like I got invited to MAS to actually like consult into like whether some of these things are more stringent or not stringent. That was like long time ago. And then we have one session where I think they really changed the wordings a bit regarding, I think more so to actually guard those financial advisors who decides to have a certain like web presence and all that, how to actually deal with it. So there's a certain decision tree lah. Like the first thing is, like the first level is that, do you know the other people's situation or not? Like the person that you speak to, like let's say Boon Song, do I know Boon Song's financial situation when I'm giving this advice? Most likely, if you write like this, right, most likely you won't know those people's financial situation. So you already failed this already. So the onus is actually up to the person listening, right, to actually make a decision. Now, if let's say I'm speaking to Boon Song, and then Boon Song has let me know his financial situation, then it comes in the second part. Do I get any monetary incentive or not? And if let's say I get some monetary incentive from it, right, then if it's considered as financial advice, and if let's say something were to go wrong, right, then I am liable. So if you go by this two-step decision tree, right, most of us won't face an issue, because if I write to 2,000 people, I have financial situation. Yeah. So there's some background on some like some of the proper stuff.
I think Kyith's side is a bit internet connection is so good.
The bandwidth needs help.
Bandwidth got problem. But still, I got your point.
I think when it comes to advice, right, I think when Kyith talked about his recommendation of small caps in the past, he really did his best to give full disclosure. Like, I recommend a stock. Let's say I got no incentive, or I recommend this stock. This is the amount of percentage I have in this stock. That in itself tells the consumer that there is the amount of belief I have in this stock, or the kind of vestedness, how much vested am I in this stock. So that is part of a message, you see, on how strong, how much belief this person has. So that to me, as long as the influencer or the Finfluencer give enough disclosure, I think that is good enough for me. But he also must be very clear on what kind of incentive he gets. As long as everything is put out front, it's not that bad.
But come back to the point just now, right? Like there's this two decision tree, right? For example, like, okay, I also created all this, TCSS session and then talk about stocks. I think there's no way for me to know the audience financials. So I can talk about what Apple, TSMC, I can talk about, okay, their business and so on. There's zero chance that I will know, right? So does this automatically consider as not investment advice? Or I don't think it's advice. To me, it's just like a content, right? I
think you're just sharing knowledge. You're just sharing knowledge. And to be fair, a lot of what we write, we usually you present pros and cons, So and I don't think a lot of people just say that this is a buy. Okay, this is below the intrinsic value. Usually they will say this is below the intrinsic value, but they won't say buy. Okay, so it's up to you to make a judgment in all those sort of things. So I thought based on this, you'll be quite okay.
Just now Hayden was saying something, right? I don't know. Like, anyone else want to contribute on this topic? Like how much Finfluencer should take the blame when this kind of things blows up? You want to?
Hey, Munti, Jay here. Can you hear me?
Yes.
Okay. If I may, I think for influencers, right, it can be categorized into two categories. I think one is those who are also victims themselves. So these influencers, they could be genuine. To put Boon Song's example, so their intentions could be good. So they probably have used the product and thought that the product is okay, it's good to use, and they share their experience, and hence, in a way, promoting the product. So end of the day, when the company crashes or when things go wrong, they are also the victim. So that's for the first category. The second category of KOLs or influencers would be those that get incentivized. So these people, to me, from my view, they are like salesperson of a company. It's like today you go to, say, a beauty spa, and then they promote certain facials, living packages. I think it's their job to promote and to sell the benefits of the products because they get incentivized, they get commissions. So likewise for all these influencers, they get incentivized, they get paid. So they're just doing their job. But that doesn't mean that these two categories of influencers should not bear any consequences. Like, I think to sum this up, all our words bear consequences, contain consequences, whether is it good or bad. Even in our day-to-day lives, when you give certain advices to your friends at a personal level, all your words do contain responsibilities. So yeah, it goes back to what you guys have pointed out earlier on, how much responsibility and consequences they should bear. Yeah, that's my view.
Thanks, Jay. Okay, we have yes.
I think because I'm a remiser, right? So I have some knowledge on this. So basically, from what my company told me, is that even as us remisers with module 6 and 6A, which is the IBF module that allows us to give financial advice, even us, we are not allowed to give fundamental recommendation to our clients. Fundamental recommendation as in buy this, we recommend to buy this stock, and this is our target. We are not allowed to say this. But the thing is, when the market is normalized or the market is calm, everything is okay, there's no problem. MAS will not clear you down. But when things go south, like high flux or FTX, then if there's a civil lawsuit against you, a civil claim against you in the court of law, then even for us, 6A module holders, they say you are allowed to give financial advice, but it's still a gray area there. It's still, the MAS still treat this as a gray area. So we still have to go to court, to fight for this. So imagine those that is not licensed, for example, those YouTubers, and they have monetary gains. And if someone were to sue them in court, it's very hard to defend yourself. First, you are not, you don't have a license to give stock recommendation. And second, you are incentivized. And then you did not do your due diligence. And if the person that is suing is educated, you are still safe. But if the person that's suing is an old man that has no education and no qualification, big trouble. There's some risk there. That's why most of the time have to be safe. When you make some kind of stock recommendations, don't say that. You must weigh the pros and cons. Always give your the pros and cons, and also do not give outright direct recommendation and price targets. That's my view.
So need to be careful. So from now on, you don't see YouTubers giving up price target anymore. No more buy sell.
Sorry, can I comment on this?
Yeah, sure.
Keng here.
Sure.
I think there is two parts to this, right? One is using the product and service itself. The other one is talking about stocks. So I think I'll first cover the products itself. So basically the FTX thing that imploded on itself. Personally, I'm financially incentivized on a few platforms. But I don't touch crypto, which is why I've personally zero interest in those particular platforms. But to name a few, Tiger, Weibo, Momo, I think those are, they basically captured the entire Singapore Finfluencer space. Oh, I thought I never on video, but yeah, they basically captured the entire Singapore influencer space. So I guess there's some sort of a herd mentality here. If one person goes down, everybody's gonna kena together. I think that's some sort of, but that's a bad mentality to begin. So I'll keep that aside first. So in terms of products, right, or recommending this kind of service, I feel like at least from the influencer perspective, it's always an exchange of social capital, right? So you build your audience trusts you. So in this case, assuming that the market functions effectively, if let's say I promoted FTX, hypothetically, if I promoted FTX collapsed on itself, the viewers, if the market is functioning effectively, the viewers will lose trust in you, and people will not trust you, people will not listen to you. And same goes for many of those people that actually push crypto in the late 2020s and 2021s. Essentially, a lot of those crypto channels actually slowly faded or fizzled away because there was no hype, there was no interest, there was no attention, and people slowly lose trust against them. So that's the first part. I think in terms of, I still fundamentally believe that this exchange of social capital is effective. If you keep pushing this kind of nonsense and people don't trust you, you'll slowly lose your audience, and people, once bitten, twice shy. I think that's the first part. Now, on the second part on stock recommendations, right? This is a more iffy topic. If let's not talk about small caps, because small caps, it's quite easy to move markets. So personally, as a Finfluencer, I have 10,000 subscribers. So let's say in overseas, in the foreign regions where they have millions and millions of subscribers. So let's assume that one person just have $10 and they put it into a particular stock. So that's at least tens of millions of dollars, or sometimes hundreds of millions of dollars to move the market cap. But in this case, if you talk about like stock recommendations per se, I don't believe influencers are monetarily incentivized, even though I have a position in it. So let's say I have a position in Alibaba, for example. Even if I tout that Alibaba is the best investment in the world, I'm quite sure I can't move a $200 billion market cap unless even billionaires are unable to move the market cap. 1 billion, 2 billion, it's not even 1% of the market cap. So in that case, I don't really see the case for specifically about stock recommendations, because I do give price targets, as in, I don't tell people to buy, so it's not a buy recommendation, but I do say that, hey, this is what I expect in 5 years, 10 years, whatever. So that's just my perspective on that.
So I remember King talk about MAS banning Binance because they are soliciting customers in Singapore, right?
Right.
So is there a similarity between like Finfluencers trying to solicit certain cryptos? Is there a gray area, or is MAS also trying to clamp down on this? But in the crypto space, I'm not very sure, because it is not a security, right? It is not under the MAS jurisdiction, Do you have a view?
So that's an interesting question. So let's say now, if I'm an influencer, I'm not based in Singapore, does it mean that I can solicit elsewhere? Like, because MAS wouldn't care, right, in that case? So if, let's say, I can't control my audience geography, so let's say now I have 10% Singapore, 10% US, 10% UK, am I subjected to the geographical clampdown on all monetary authorities?
Yeah, that's why in crypto space, it's very hard to say because it's not regulated. It's not counted as a security. So I don't know what is it, But in terms of giving recommendations, MAS will not clamp down on you. But the main thing is not about MAS, It's about individual investors that got burned bad. Then they will try to, they will try to blame someone. They will try to have a civil claim on you. And then if this thing happens, you need to have ways to defend yourself. You need to put in a lot of layers of protections, like disclaimer, and the way you talk and the way you recommend have to change. I think I'm also capable of this, trying to change also.
I think also that there was this discussion the other time where they were saying a lot of like this Finfluencers always say it's not financial advice, and then they'll put like one long text of things, and clearly I believe not a lot of people read through the whole long text of things. So it's like the terms and conditions, you just click and then okay, next. But does that actually prevent you from being not culpable? I think there was this video from Legal Eagle. He actually says that from the US perspective, it still makes you culpable. So which is why I'm not law trained, so I don't really know what exactly is going on. But I'm just expressing my concern as a fellow partner in this ecosystem. I hope I get that right, or get that across.
Yeah, for what I know, disclaimer cannot fully protect you. That's why you can see bloggers like ASSI wearing a mask, don't put your name, hide everything, for safety.
Yeah, I also don't know, like I think for chicken situations, you talk about like all companies like Alibaba's, right? Like say for example, someone who is not so educated in stock investing, they just watch your video and just whack half millions into Alibaba, and then the share price drop, then they lost money, right? Then they want to sue you. Would this be a situation that's hard to manage, right? So I think from legal perspective, there's still a lot more to find out. Okay, anyone else want to contribute on this topic? If not, we move on to the next. You guys are still here, right? Suddenly it's silent from my side here. Okay, let me go back to the share screen. I think we have two more questions to go. Okay, let's and Chicken is here, right? So stay on the Chicken for the last one. I think there's something to discuss here. I think this one is quick one. Why are shares buyback good for shareholders or investor? My personal view is that share buyback itself, we don't know whether it's good or bad. Especially there are situations that the companies do share buyback where the price is at, let's say, $100, and then when it dropped to $30, they have no more money to do share buyback. So I think that one is really value destroying for the investor who remain with the companies. So I think share buyback itself, hard to say good or bad. You really need to know like where the money's from. For example, if they have generated a lot of free cash flow, for sure you have to return the money to the shareholders, right? It's either via dividends or share buyback. I think share buyback is a lot better in terms of from the tax perspective. And also, if the share price is really low, and share buyback always help, right? I think Apple is the best example because there's one point of time where they traded at a very low price because people always thought that the valuations or the growth would slow down. But then they just use their share, their cash to do a lot of buyback, and you can see that the outstanding shares shrink a lot, and that one will boost up the EPS and so on. So I think these are the success story of share buyback. But of course, there are quite a number of failure as well. For example, the one that I said, they did a share buyback too early in the process, and then they have no money, or they put their company's financial at bad positions. I think that's one example. So I think really have to see that. But for me, I don't think the buyback itself is the one to look for. We should look at the business, whether it is able to generate free cash flow or not. Because if the company is able to generate free cash flow, even if they don't do share buyback, you can see the share build up in the companies. I think this one's still considered the money belong to the shareholders. So hard to generalize. I think just let's put it that way. You guys want to contribute on this? Yeah.
If you look at the book by Christopher Myers, which you passed me very many months ago, right? One of the chapters, a small one, is attributed to share buybacks. In a long-term perspective, right, how many shares did the company bought back? And most of the time, right, those which stock returns more than 100 or close to it, they have a very good history of share buybacks. So it's easy enough to look at it from a long-term perspective. Maybe not in just these 2-3 years where a lot of companies they have no good news to offer other than to announce a share buyback program. That is so common, and maybe adds no value. But maybe as us as an investor, right, we should look at the past 10 years, 20 years, and look at what the company does. Is the amount of share outstanding, is it lower? Yeah, that's the big question. Share buyback works, but long-term perspective.
It also depends, like share buyback, right? You have to look whether they put the shares that they bought back into the treasury. If it's put back into the treasury, right, means the total issued shares is still the same. So, but you want them to cancel it, destroy it, so that your EPS and your NAV will go up. But that being said, like a massive amount of share buyback means that the management is actually very confident. For example, if you look at Alibaba, they have a $40 billion USD share purchase plan, which is almost 1/3 of their enterprise value. So it shows that the company, the management is very confident, and that amount, I mean, is free cash flow sustainable because they are making about 20 billion in free cash flow in USD every year. So see how it goes, but it also shows how the level of confidence that the management has.
Okay. Any other views on share buyback, good or bad? Yeah, if not,
sorry, Jay here. Quick question to Bunty and maybe the rest as well. I think last year Meta did a massive share buyback when its stock price was at 300 plus. Any thoughts and views on this? Is it because they were very confident about the future, or was it like a miscalculation, or they have just too much money to spare and then they are doing the share buyback?
Hayden, do you want to go? I think you're on mute.
I think for US context, share buyback is a form of tax-efficient dividend payout. So I think that's what they're trying to do. And most of the time, share buyback for companies, there are many reasons. Some is to show confidence to OPMI as in retail investors, and some is to because they have a lot of money, and the best place to put the thing, right, is their own company, So there are many reasons to it. So unless you ask the management, it's very hard to know what's their true reason. And also, if you say a huge amount, you have to look what is the percentage to their market cap. Is it a large percentage? If it's a large percentage, then it's big, then it's huge. If it's like, for example, 10 cents, it's less than 1%, then yeah.
Yeah, for example, some companies do share buyback only to offset the dilutions because they also give stock options to their employees. So they continue to do that, but in the end, you see the outstanding shares still constant or doesn't change a lot. So I think that one is completely different compared to like in Apple case, where you can see the outstanding shares really drop a lot within that 3 or 5 years time when they do a massive share buyback. It's very different.
Yeah, sure. Sometimes the companies, they do share buyback, right? They use the company's fund to do share buyback, and then they use the shares as option staff option, share option for the staff. So basically using company money to pay the employees,
But it looks different in terms of the financial statement, because if you pay your staff using cash, then you just expense it right away. Whereas we do it using stock option or whatever, sometimes the value will be a lot smaller compared to what is the real value that has been transferred over to their employees. Okay. Thanks, Jay, for that questions. Let's go to the last questions, which I think was posted by Keng. Time-weighted return versus money-weighted return, which is better? I think this one, there's no good or bad here. It's just a different calculations. So I think for those who don't know about the background of these two different return measures, for time-weighted returns, right, what happened is that you look at the time period. Say, for example, every month is your time period. You just look at the change of the index, for example, or change of the prices to return to calculate the returns. And once you have the return from January to December, you just change that over. Basically, you just say, okay, let's say 3% is 1.03. If you lose 5%, you times 0.95. You just product across 12 months, you get a time-weighted returns. So time-weighted return, you don't care about money that the investor put into the portfolio or the money that they take out. So they don't consider fund flow at all. For money-weighted returns, it's exactly same as like IRR calculations. Say, for example, you buy a stocks at $100, then it dropped to $10. Then you put in fresh capital in there, just 10x the money in there. It just need to go up another 10%. Maybe you're already positive, right? So you will only get a positive if you're using money-weighted return, because after the share price drop a lot, you put a lot more money in there. So in terms of the return, right, the second part will determine your overall return, because you put a lot more money into the portfolio after it drops. So basically, if you do a money-weighted returns, it will influence by the fund flows or the money that you put into the portfolio or the money that you took out. So it's very different calculations. There's no good or bad. It just depends on what is the purpose of these return calculations. So say, for example, you manage your own money, and then sometimes you take money in, sometimes you put money into your portfolio, sometimes you take out, right? In that sense, if you want to know your real returns, right, like exactly how much return that you generate from this portfolio, you should look at the money-weighted returns. Because you can have 2 periods. The first period, market went up by 30%. Second period, market go down by 30%. But actually, most of your money, at the midpoint, you actually put a lot of money in. So you might earn 30% on $50,000, but you lose 30% on like 1 million because you just put money in at the peak and then market crash. So overall return, money-weighted return will be very bad, because your exposure, you are more exposed to the second half, right? So that one money-weighted return determines your true returns. Then the question is, what's the use of the time-weighted returns? I think the time-weighted returns is mostly for return calculations for the managers who don't determine the fund flows. Say, for example, like I invest your money, okay? And then I pick my stocks, but money is yours. But you determine when to put in money in, okay? So in that sense, I could be, let's say, split again to 2 periods, right? The first period, the losses is negative 20%. And then second period, I gain 40%. So if you just look at time-weighted, negative 20 plus 40, by right, it should be positive returns, right? So I have generated return for you. But for the same portfolio, if you lose 20% on 50,000, And then the second period, when I earn 40%, actually you put on money in, and that actually shift the overall returns. The money weighted return is much more worse, or for example, right? So should I be penalized because of your fund flow decisions? So I think that's the reason why we have a time weighted. So to keep it short, if the manager doesn't determine the fund flow, so that manager should be judged based on the time weighted return and not the money weighted returns. But let's say if you are managing your own portfolio, you are the one that put the money in, you decide, you make that decisions, right? Then you should look at the money weighted returns. So I think this one is clear cut one. Once you know like the fund flow decisions, whether it's done by the manager or done by yourself, then you will know which one to use. So I would say that for most of the, let's say like all these unit trusts and so on, they will always just report the time weighted returns, because the money weighted returns will be different. Say for example, S&P 500, right? If we say time weighted return, everyone will get the same time weighted returns if you invest in S&P 500. But every one of us will get a different money weighted returns because we put our money at different time point. Okay, just you put money in 1 week before me, or 1 week after me, we don't get the same money weighted returns because we enter at different price, right? So I think that's the clear way of to look at these two different return measure. So I hope that clear. Chicken, please ask some questions if it is not clear for you.
No, as in, so thanks for the explanation actually, Buti. I think I wanted to explain like the objective of why I asked the question in the first place, because I had this very interesting discussion with a friend. So I think it voices down back to what's your investment philosophy or how you invest, right? So I mean, for myself is when the share price go down, I actually buy more. Like I always start a small position, and then assuming that fundamentals are still okay, things are still going fine, and sure, it's experiencing some sort of headwind. But if you have more capital, you're supposed to deploy more. But then I had another friend that totally disagreed with what I did. So he's saying that clearly the market is not dumb. They are pricing in something, and by doing more, you are basically increasing your risk by a larger extent, because you are trying to put in more money to the portfolio. And then, which is why we started debating on using time weighted return or money weighted return. Personally, to me, I think at the end of the day, all of us just want to earn money. Like you're putting your capital, you're betting on a certain level of risk, and then you want a certain level of reward, right? So we all just want a green portfolio at the end of the day. So whoever, a same stock, like for example, let's take Alibaba, because I'm quite familiar with that stock, to say the least. But the same returns profile, like the same graph, people can earn money because somebody went to all in at $60, and then now they are 50% in the green. While somebody on the other hand, like me, I averaged down for 2 years and I'm still down like 30%. So that same stock, same movement, but can have vastly different results. So that's why and also if you started averaging down from 2 years ago, if you average down more and more, right? Actually, you might be in the green. I'm just saying hypothetically, you might be in the green. So which is why I think money weighted returns should be the quote unquote superior way to do it. But I understand why fund managers or UTs or wherever use time weighted return, because they don't control the movements of the fund flows. But yeah, I just wanted to hear your thoughts on it.
Which I think explain as in that question's already been answered, right? Because for managers, they just manage the portfolio. So whether you average down or not, or whether you take your money out or not. For example, like Alibaba, if someone bought at $200, they sold at $100, okay? And they already closed the entire positions, and Alibaba go to $1,000. So if you do a money weighted returns, for sure, many investors will get a green. But for that person who's bought at 200, sold at 100, Alibaba can go to $100,000. Still, they have negative returns, right? Their money weighted return is negative because they already exited all of them. Like it doesn't affect their result anymore. So that's why I'll say that for him, for that specific person, he should look at money weighted return to determine how much money that he make, right? Yeah.
I think the argument is also, as in, okay, so a lot of the investing legends say it's impossible to time the market. Don't time the market, don't bother. Like it's very hard to catch the bottom. But clearly, I think there is a certain truth to it where timing does matter. Your entry price do matter. And like I said, if the ultimate goal of every investment paradigm is to earn money while managing risk, then Which is why I think money weighted is I mean the superior way, but that's because I'm a retail investor myself, so I can't comment much on how the industry works.
But come back to this time weighted. Say for example, the manager is managing their money. They don't control the fund flows, and then you keep on still saying that because money weighted return is the one that determine my returns, and you keep arguing the same thing again. And I mean from the manager's perspective, it's like I cannot have a meaningful discussion with you if you keep on talking about money weighted returns, because I myself I don't determine the fund flows. So for example, I think there are managers. I can't quote the examples. I definitely can tell there are situations like this where they wanted. Say for example, if you are managing a portfolio and you only have Alibaba here, right? You say that it's already dropped to $60. If you can determine, you say, I should put a lot more money in. But if you are the fund managers, you actually can't do that because you are just given whatever monies that put into your fund, you just invest that funds. So you have zero control at all. If someone use a money weighted return to attack you, it is not fair at all because they have zero control on that, right? They are just the fund managers. The ability to control the fund flow is a big thing. Like it will affect the calculations.
Yeah, I agree. I agree on that point. But from a fund management perspective, it's more of they're deploying capital, right? Like they manage the capital on where they move, and sometimes they probably put in like I don't know, a 3-year lock-in where you can't take out your money for the first 3 years or first 5 years because they want to manage the fund flows. So actually, in a way, they can kind of manage the fund flows, or they can set up barriers to make sure that you can't move your money. So yeah, which is why, and yeah, that's that.
I think this one depends on the type of funds. If we are talking about unit trusts, mutual funds, they cannot do that, right? Yeah. If you talk about hedge funds, you talk about some like a financial advisor, they have some influence on their customer to put more money in, for example, right? Then I think that one is a bit like gray area already, because they have some influence on that. Okay, they can tell their clients that, hey, actually, you know, last year when you asked me Alibaba is a good buy or not, I told you maybe don't put too much money in. Then now actually the price is a lot lower. You should put more money in. This kind of statement, if they can influence, then I think it makes more sense to put on the money weighted because they can influence. If not, right, talking about like the retail funds, right, they have zero control. So time weighted is the only measure that we should look at.
Yeah, so and that really financial advisor is giving financial advice by asking the person to put in more money at a low time. So need to be careful on that. But yeah, okay, I agree. I have no qualms against that.
Like, is it correct to say that time weighted return, right, is used to track your performance against indexes? Like how do you outperform that particular index? And then XIRR, the money weighted, is more troublesome because, like, for example, that particular month you go up 20%, right? Then they will annualize it to give you a ridiculous number, like you get a 3,000% increase in your money weighted return. So it distorts everything, it makes everything very confusing. So if you want to compare against index and whether you have outperformed particular indexes, right, use the time weighted return.
Yeah, because if you want to compare against index and then you use money weighted returns, then the index returns is different for every investor. So it doesn't make sense at all. So there's only one, like when I talk about S&P 500, I cannot be like, hey, S&P 500 dropped by 15%. Then Kyith suddenly say, no, it's jumped by, it actually just dropped by 5%. Then Boon Song come out and say, actually, S&P 500 dropped by 5%. We are talking about this year, same period, everyone have different numbers because we put money in at different time point, right? It cannot be that way. So there's only one return from S&P 500. We all agree the return on S&P 500. So it has to be time weighted, and time weighted, of course, compared to time weighted. That's why we have the one that you say, if you are comparing against benchmark, it's always come back to the same time weighted return. In fact, if you look at the fund fact sheet of whatever funds, right, when they stated the return, it's always time weighted, and the index also time weighted. The money weighted is only come in when we calculate what's the actual returns. So that one you will be influenced by the fund flows. Yeah. And yes, I do agree with your statement on the money weighted return as long as you use the XIRR calculations, especially if you are talking about periods shorter than 1 year, you get all sorts of funny numbers. And XIRR also sometimes you can have two numbers. So say, especially for example, like you put in money, then you take out, you put in, you take out. Actually, I mean, this one is mathematics. You can say, okay, actually my XIRR is negative 5% or positive 10%. Both are correct. Also can be that because of the solving the equation. Sometimes you get more than one solutions. So that one is really mathematics. But then XIRR have a lot more other funny situations. Yeah. Okay, I think we are done with all the questions. So I don't know, like, you guys have any other questions that or any topics that you want to talk about, since there are a couple of us here, right? So can post your questions.
I think previously we all talked about timing the recession, right? I think trying not to time the recession. I mean, in terms of China context, like, I think that these 2 years is very similar to like subprime crisis, and also like 70%, 80% drops. So for me, right, in my own view, right, is choose companies that really attract top talents, and they have very strong free cash flow, and they are buying back their shares. You definitely do not want to buy into any stocks or average down in any stock that's loss making, and in the end they want to do rights issue at the bottom to survive. And it's a disaster. So let's continue to buy into this. It's your chance to buy into blue chip stocks in China context. And then I would be fairly confident that you will do well over time, because all these companies, be it Alibaba, Tencent, or Kingsoft or whatever, they are all private companies with foreign investors and with foreign board members also inside. So the amount of they are quite aligned with OPMI, because all these directors and these employees they get into those share-based compensation. They also get into the similar shares as us, So, but if you talk about state-owned companies, then you have to be more careful, because the money that is used in the state-owned companies may not be aligned to shareholders. They might be aligned to a country. For example, Ping An, they use the money to build out dying property developers. That's not aligned with the shareholders, So there are a lot of this kind of thing in state-owned companies, and these companies have a lower valuation because of this,
Yeah, Keng just bought into Chinese bank. So you want to comment on that? That one is state-owned enterprise, right? We're not talking about the merchant banks, right?
Right. So I mean, good and bad. There is two sides on the same coin. Sure, I mean, they need to do some level of national service as well. But the other side of the coin is they are immortal, means they won't die. So for example, like Chinese banks, your Big 8, your Bata, Inhang, all won't die. Or even your Big 4, your Big 5, they won't die, because they have to save the economy and the what. I mean, I personally do agree with most, or if not all, of the points that Hayden actually mentioned. I think the Chinese bank part, why I invested, it's a thesis of its own. I have another, there are more nuances in terms of that, but I do generally agree that private companies, especially strong ones, they're like springboards. They'll bounce back. It's just that you don't know how long, and then your returns will be largely affected by the timing you enter and how long it takes to recover. That's all. Yeah, for Ping An, I can't comment much because I'm not personally vested. But yeah, I only have banks. Oh, and side note on this whole how he said that it was a subprime mortgage crisis for the last 2 years for Chinese stocks, right? Actually, it's specifically to tech only, because there was it's a subprime tech crisis, I guess, if you can put it that way. Because if you were to look at the major indexes, like their internal local mainland index, they actually never move much, 10-20% year to date max. I think in the last 2 years, 20+% max. And then that's why the economy is not really reflective in the stock market right now. I don't know whether it's artificially being boosted by the government, because there are many instances where they keep asking the banks to keep buying back shares. Or as in to support the stock market as well. So it's a black box in the Chinese stock market. So I do caution people, not financial advice, but please do a lot more due diligence compared to your US stock counterparts.
Keng, have you looked into the most private China bank, China Merchant Bank? It's the closest to private company, a private bank compared to the other state-owned banks.
Sorry, can you repeat? I think you got break off. Yeah.
Have you looked into China Merchant Bank? I think it's the most private kind of bank in China.
It's one of them that I looked into. Currently, I don't have a position in them. I'm not really, I can't really like dissect them, saying that how private or how public or how state-owned the every enterprise is. But I mean, just to disclose, I have positions in 4 of the big 5 lah. Like the 5, right? ABC, okay, don't want to swear. So Agricultural Construction Bank, Bank of China, ICBC, and Bancom. So out of the 5, I have 4 lah. But it's not a big position. I need to manage position sizing as well. Yeah. But in terms of China Merchant Bank, from what I understand, they actually do have this investment arm of CMB, if I'm not wrong. And the investment arm have a huge percentage ownership in China Merchant Bank. And that investment arm has a PB of 0.22. So when I saw it, I'm just like, I don't know what the heck is going on, but I unless I know somebody inside, if not, I also don't dare to touch.
Because China Merchant Bank is not owned by the Huijin CCP lah. It's not there's no like massive stake by the Chinese government. It's only like 17% owned by the China State-Owned Asset Supervision. So you can look at their top bottom line. Their growth is more realistic lah. If you look at the state-owned banks, their bottom line is always like, oh, just nice, 4%, not so much. Don't report too much. Then don't be loss making also, just nice. Every year is like you can draw a very nice chart, you know? It's like manipulated, you know. So have to be careful.
I think for that, right, I do agree. It feels a bit fishy the time when I first saw. But the underlying argument, at least for my main thesis, was it's majority owned by state-owned. So they all own. So for example, like ICBC, I think 70% is by government, either government agency or the Ministry of Finance in China. From what I've read or what I've teased out, actually a huge part of the local government funds actually come from all these dividend plays. So they actually issue out. It's a huge portion of their local government budget. So the dividend yield, they cannot anyhow, suka, they just cut. So even back in 2015, 2016, when China was experiencing or clamping down the shadow banking space, and even in 08, 09, the dividends are held relatively constant. I don't know where they get the money, whether the whole books are all cooked or whatever. That one I choose to not know, but I think in terms of a dividend yield wise, right, if they are paying out like, because I bought it at a low, it was one of the lowest valuations. If they can keep paying out, you hold it for 10 years, I think your capital is back. I think this just a kind of a safeguard in terms of the thesis of these investing into these banks.
Yeah, on the bright side, yeah, their NPL allocation, the buffer is quite high one.
I think it's also manipulated.
CT1 is also very high. So if you trust the books, they are actually very safe. But the thing is, they have to save the property developers. So they are the first in line. And also, a lot of people are talking about shadow banking and how true is their balance sheet. So have to be more critical.
Agreed. Whoever listening, please don't take this as financial advice also, because many of their price to book now is at 0.3, 0.5. So it means 30 cents a dollar for many of these banks. So, and we are talking about like the biggest banks of the world. I mean, based on what they declared, their assets are bigger than JP Morgan, Goldman Sachs, like your ICBC, your Bank of China, all these have bigger assets on their balance sheet. So yeah, take it with a pinch of salt.
Very, very quickly, is there any way to explain the discrepancy in the pricing between the A shares and the one in Hong Kong? Because I assume that you bought those in Hong Kong, right?
Right. So pricing discrepancy, you mean by... So that was the first question I asked also, because in terms of dividend yield wise, right, I don't know why in the A shares market it's 7%, while in the H share market it's actually 9%. So that was the first cut when I looked into it. Long story short, I don't have a very comprehensive answer, but what I understand is, number one, FX makes a big difference in terms of that dividend yield because it's trailing 12 months. So the renminbi actually depreciated quite significantly. In terms of the tool where you talk about pricing discrepancy, can you explain further what do you mean?
It's like year-to-date drops. Basically, if you look at the year-to-date drops for ICBC listed in listed in China A share, the year-to-date drop would be 9%, whereas the one in Hong Kong would be 13.57. So maybe you can explain it off with currency exchange. But it does feel like the dividend yield, the dividend yield is the big difference.
No, the A and H discount, basically the price discount has been there for many years already. Mainly because the A and H are the China and Hong Kong, the exact same banks are trading at a discount. Why? Because they are not fungible. So basically, if you own A shares, you cannot transfer to H shares. There's a line there. And also in China, I don't think they forbid or they clamp down on people that they're shorting, and there's not many foreign investors inside. But in Hong Kong shares, you can short lah, and then there are a lot of Western house or funds inside. So their perspective of China banks is very different from what the domestic people think And the main reason is it's not fungible lah. So even if you own the A shares, you can't convert and convert to the H share. So you can see the price discrepancy is due to different opinions and also the shorting on the market.
Yeah, I just have one question on this, right? Like Chicken, when you bought into all these Chinese banks, are you aware of the exposure to the overall real estate market? It's like a proxy exposure to the real estate, because all these banks, I believe, quite a sizable portions of their exposures still come back to the housings, right?
Short answer, no. Long answer, I think it's not really. In terms of fitting into my thesis, right, I'm not really concerned about it because, like I said, even though it's state-owned bank, right, the biggest buffer is I know it's immortal. Immortal meaning it won't go anywhere, and there's very big. I mean, like I said, right, I think there are three main bear theses that I had for going into it, meaning that I have to be concerned about. Number one is diluting of shareholders, meaning they need to issue equity to get back the money. Basically, your 2008 crisis in layman, right? Citi had to give a lot of shares to the government, and then they had to dilute shareholders. But for one, I think now, like I said, the majority of the shareholders now is local government. So if they dilute, they're actually diluting themselves. But I mean, there's still a possibility that they're going to dilute in order to save the real estate economy. I think that's one part. Number two is if their dividend yield remains relatively constant, even in times of crisis, which is the 1516 and 2008, right? I might expect a dividend cut. Yes, I do agree. But let's say I buy in with a significant enough margin of safety, because current valuations, or at least when I bought back in last 2-3 weeks, when the whole CCP thing, party congress, all those nonsense, right? Then everything tanked, right? So when I buy with a significant enough margin of safety, I'm kind of protecting myself from that problem, because I'm not buying at a relatively high valuation. I'm buying at like historical lows when I go back 30 years, 40 years. Like these are all really trading at like 0.3 price to book. I see already, I stun also. I mean, I'm not like I said, not financial advice, but I see already, I really stun. But of course, I cannot use the same investing framework when I look at US or Singapore bank stocks compared to like China bank stocks. But truth be told, I think other bank stocks, their books, you say, is perfectly clean. They have no backlash. I personally also don't really agree. So it's basically like all the ships are black. It's just that which ship blacker only. Then the third point is, it's a dividend play. I'm intending to stabilize my portfolio, because my portfolio now is extremely volatile in terms of like the tech exposure. They can go up like 30%, go down 30% in 1 month. So these banks, they are relatively stable in the grander scheme of things. And like I said, because I bought at a cheaper valuation. So that's that.
Yeah, I think there's one question from the chat. Since on the topic of property in Hong Kong and China, anyone can comment on linked REITs as a long-term investment instead of SG REITs?
No comments.
I think recently linked REITs, they are acquiring one of the properties in Singapore, right? I saw that.
NTUC. They are said to be bidding for some of the properties controlled by Mercatus, which is actually NTUC. But linked REIT is what's the thesis on linked REIT? Hayden.
I only remember linked REITs is just a REITs, but their exposures, I think most of them is in Hong Kong, right? That's what I remember vaguely. So what about Hayden?
They are the largest real estate investment trust in Asia. But the thing is, have to be more cautious with the Hong Kong property, because it's still on the high side and it's currently dropping. So you might face some kind of a valuation impairment, fair value losses. And also the Hong Kong lease is very different from Singapore. Singapore is 99 years and freehold, right? Hong Kong, I'm not very sure. Is it 70 years? Wendy, do you know? And then
no, I don't know.
And once you hit a certain timeline, like 20 something, 204 something, there's a clause where the deal with the CCP expires, right? There's some uncertainty there, compared to.
I only remember for linked REITs, I think their dividend yield is not bad. That's the only thing I remember. But I think for REITs investment, the first thing to look at is the exposure, because it's like SG REITs. You still have to determine whether it comes from which sectors, right? It is office REITs or mall REITs and so on. So you want to get the exposure that you want. And then for link REITs specifically, I think this one, the geography, you need to look into it and be comfortable with that geography. Anything to do with Hong Kong and China, I think because of all the previously there's all this crackdown, and then I think the real estate also get a hit, right? You want to take that into consideration. So yeah, I think that will be it.
I mean, if borderline, right, if you are even considering touching the property sector or whatever, just kind of understand that it's like distress investing. So it requires a different level of hit, like a different mentality when you look at like many of these investments. Yeah, just a word of caution also.
Yeah, and also pay attention to the leverage, because all these REITs investment is still a leverage exposure. I think that you just look into the balance sheet, you can see that there's liabilities on the book. And for, I think in Keng's case, for banks investment also, the business model itself is leverage model. So might want to pay attention to that. So yeah, but I as I said, as what Keng mentioned, if the share price is dropped low enough, that's margin of safety. But still need to pay attention to leverage. Any other topics that you guys want to discuss before we close the call? It's 2 hours already.
Just be careful about REITs. I mean, recently I've been stuck at home, so I've been looking at what the most depressed REIT in recent times, Manulife US REIT. And along with Prime, I didn't look at Prime, but I look at Manulife. And then if you look at Manulife, right, the numbers already suggest problems before COVID. And it didn't also show any kind of recovery post the worst of COVID. So when you look at the incentive of a REIT manager or a REIT, right, is to expand AUM. It's going to be very, very difficult for a REIT to turn around, especially when it's actually a perpetual refinancing instrument. So when it comes to REIT, right, you want to look at how much debt it has, how much fixed rate it has, and what kind of maturity it has. I tend to look at things that from a recovery possibility position rather than growth. Yeah, sorry.
What's the problem that they are facing?
They are facing lower and lower, what do you call that?
Occupancy?
DPUs. Vacancy also dropping. But as a whole, right, it's a sector issue. Office REITs are not popular. Vacancies are on the high as in vacancy are increasing as a sector. So you can attribute it. Could you attribute that kind of problem to management issue? Because if a stock has management issues, right, then you better steer clear. But if a REIT, right, you tend to look at REITs because they have this problem with what do you call that? Conflict of interest problem. They want to increase their AUM. So for them to sell off their properties, right, in order to alleviate their current problem situation, right, it's a very low possibility. So they probably thinking about how we change the way this property is being used. So they are talking about converting one of them into a hotel-like property. Yeah, but from the way I see it, changes are going. The properties that they are talking about are actually their smaller ones, and it doesn't look like things will change very soon for them. But so when you look at it, right, you want to think about how long you can tahan being in this property. I mean, being in this REIT, and whether the valuations are on the low side. So you're looking at it from a recovery possibility angle. As for Link REIT, I don't know. You look at the kind of properties they have, like you say.
No more other topics to share, then we close the call here. Thank you so much for everyone who's joined the call. Kyith, Hayden, Keng, Boon Song, and for those who didn't turn on camera as well, like Jay, must turn on camera next time. All right, thank you so much, everyone. And just for just an update, I think there won't be TCSS for the next 1 or 2 weeks because I will be away. So yeah, there will be less content coming up. Hopefully, December will be a quiet month and everyone enjoying the vacations and relaxing months. Don't be too. Hopefully, market won't get too excited about what more crash or things like that. Okay, thank you so much for for tuning in, and see you all next one. Thank you so much. Bye-bye.